But let's keep it with a fundamental view on the markets. Pankaj Tibrewal is Senior VP and Fund Manager Equity at Kotak Mutual Fund. He now joins in to assess the markets as well as earnings and lots more. Good afternoon, Pankaj. Let's talk about the overall market momentum right now, especially given the fact that you have so many big earnings coming in. So far, how would you assess it? Do you see quite a bit? How much confidence do you have that, this kind of momentum that we've seen so far will continue?
If it look at the Q4 earnings, I think it's early, but whatever earnings have been coming in, we believe that the quality of earnings momentum is quite strong. A lot of domestically linked companies, whenever we have interacted with them over the last 3-4 months, the momentum seems to be very, very strong. Many of the companies have told us after many, many years that they don't have capacity or they are running short on capacities. So our call is that over a period of time, if economy starts to improve, I think a lot of companies show earnings momentum. However, for the market as a whole, this year may be a more of a consolidation year. Last 3 years, if you look at markets were moving up, sentiment was extremely positive, macro was favorable, but earnings was not catching up. However, this year, if you look at, we believe that earnings start catching up. Maybe macro is less favorable, sentiments are slightly negative, hence it's a role reversal for the markets. So let us consolidate this year in a range with earnings moving up, and that will give direction for the markets over the next 6 to 12 months. Except the PSU bank pack and the corporate lenders, I think earnings momentum this quarter we expect it to be quite strong.
Right. Pankaj, talk to us about how critical election scene will be this time around for market environment, because we have just about 12th or 13th of May onwards, people will start talking about Karnataka election outcome, and then of course general elections, and of course other state elections like Chhattisgarh, etc., Rajasthan. Could market get nervous if BJP leadership gets challenged?
So clearly, if you look at over the last couple of months, market seems to be discounting the election results either of states or in 2019 to a certain extent. But yes, you are right. This is an election heavy calendar this year, led by Karnataka, Rajasthan, MP, Chhattisgarh, and then followed by the general elections, which will keep all the market participants occupied and guessing. However, if you look at a large part of negativity seems to be in the price, but as a country, we have always kind of either underestimate or over exaggerated politics. Look at 2004, 2009, 2014. In all these years before the elections, the thought was something and the results were something else. So rather than occupying our energy time in predicting political results, what we as a team try to do is look out for companies which will grow irrespective of whatever the political outcome is. And we believe that if you bang on good companies, good management with strong moats, politics doesn't make too much of a difference. Yes, in the short term, there could be nervousness, there could be overexcitement leading to politics, but over a medium to long term, it all just nullifies and good businesses keep on compounding their earnings.
So what is your hypothesis then for 2019-2020 earnings? How are you seeing it shape up?
So today, I think the street is almost like 19-20% earnings growth. We believe the actual earnings growth which would come out could be slightly lower because a few of the corporate lenders, and one of them we saw the results being declared last week, declared a loss. So those things could drag a bit of nifty earnings this year, and our estimation is a more realistic number could be around 14-15% for FY19. If you look at FY20, I think there where the real pickup will happen, all the reforms we have done in the last 12 to 18 months, mainly GST, the IBC process which is going on, the RERA process which is on. So I think all these things will start materializing your earnings in FY20. So I think FY20 you could see further momentum being picked up from the FY19 base.
Pankaj, now, if you look at the Nifty, if you pull up the Nifty graph for the last 1.5 months or 2 months, you would see that the Nifty, after making a low of sub 10,000, has come back 5-6%. And we'll pull up the Nifty graph for you last couple of months. Broader markets have rebounded even slightly more than that. What have you been adding in your fund in that kind of a market correction?
So, we believe that this year will be more of a bottom-up stock picking market. This year will be back to quality. This year will be back to growth at reasonable price. And if you look at the last calendar year style, it was momentum, beta, junk, financial leverage, and so on and so forth. However, this year will be a reversal back to quality. We haven't deviated from our discipline, from our portfolio discipline and our style. We committed to remain in quality stocks. The sectors which we believe are linked to domestic economy would continue to do well. Whenever we interact with most of the auto ancillary, their order books are full. They are running a very high capacity utilization. Any company leading or catering to say CV or tractors or passenger vehicles are complaining of capacity shortage. That's the segment we are positive on the mid-cap side. Specialty chemicals again seems to be coming back, and that segment is also a good proxy or a hedge for rupee depreciation in case it happens. Third is, I think, cement. We are seeing very strong volumes in cement for the last 4-5 months. Though pricing is a bit subdued, but our belief is post-monsoon, cement pricing also should bounce back quite sharply. Construction and engineering is another sector where after almost 9 to 10 years, we are seeing very strong traction starting to build up.
So in your key fund, what kind of returns have you clocked? Can you tell us, and are you confident of repeating that performance over the next 5 years?
So clearly, if you look at the funds have done decently well over the 5-year period, and Kotak Emerging Equity, which is the flagship mid-cap fund, has done decently well with about 28-29% CAGR. I don't remember the exact number, but we believe that if you maintain a discipline and a quality-oriented approach, I think over a period of time that's bound to reflect on your portfolio returns. For example, if you look at a few things which we look at while selecting the stock, one, the company has to be a good capital allocator over a period of time and over the cycle. And if they are good capital allocator, it starts reflecting on your return on capital and return on equity. Second, the management has to be passionate enough. We see a lot of businesses masked under the commodity umbrella, but the promoters, through value addition, through various things, make that business from a commodity to more like a FMCG play, and it's clearly reflected on their balance sheet and cash flow. Third, to us as a house, we believe that earnings is a second most important. The first we believe is cash flow, and we are a lot more cash flow focused house rather than earning focused house. And a lot of our picks over a period of time, which have been multi-baggers, have come from giving more attention to cash flows rather than earnings itself. So we believe that if you keep repeating those things again and again, I think over a period of time, there are ample number of companies in India with great promoters, great management, which offers that wealth creation for all the investors in India. And we believe that the next 7 years is the most exciting time for Indian equity market investor. We will add probably another India to the current India. That means from 2.5 trillion GDP, we expand to 4.5-5 trillion GDP. And a lot of companies probably will come on the anvil, which would create wealth.
All right, Pankaj, we'll let you go on that one. Thank you so much for joining us. It is always wonderful to have you on the show.